Good. All right, I'm just going to let people fill in for a moment. All right, I'm sure people will continue joining over the first few minutes, but I'd like to go ahead and welcome everyone. Thank you for joining us for our Q4 2025 financial markets update. We're excited to welcome you, and along with Steve Galley, our Chief Investment Officer, who will walk us through what's shaping the markets right now and what to look for as we close out the year and head into 2026. So just a reminder, today's session is meant to be interactive, so please ask your questions in the chat or Q&A as they come to mind, and we'll address as many as possible at the end of the discussion. So thanks again for being here, and with that, I'll turn it right over to Steve.
And thanks to you, to the lovely Katie Bishop, and thank you all for joining today. Welcome. I hope this proves to be informative. And as usual, we'll try and keep it to about a half hour before the Q&A starts. So, what are we going to cover today? Well, first, we always talk about what's in those headlines. What's everyone seeing in terms of the markets and popping up in the newspapers? We seems like we can't help but talk about artificial intelligence and all the hype around that. We're also going to talk about, whether the market is flashing some warning signals. And, at the end, we will have Q&A. And also we want to actually, I think with this Q&A, we do get some very interesting questions. And we also want to talk about some of the most common mistakes we see clients make when it comes to finance and investment. So we're gonna touch on that in the Q&A. And so as a reminder, this is our last webinar of 2025. So thanks for joining all throughout this year. We look forward to continuing these webinars next year, but also wanted to say happy Thanksgiving. Hope everyone has a great Thanksgiving and has lovely holidays. And so with that, let's get into it. So a lot of the transition that we made from one broker dealer to another still raised a lot of questions. So I do want to talk about that a little bit. And one of the analogies that seems to work really well is I love trees, and so I use trees quite often when I draw analogies. So when we talk about what does a broker dealer do, and in this case, particularly Cetera, because as many of you know, we moved, or Advantax was bought by Cetera, which is a big broker dealer. What does the broker dealer do? Well, essentially, the broker dealer is really like the tree trunk. They are the core that is needed for firms like ours to operate, right? They provide regulatory supervision and compliance. There's a lot of technology that we leverage from them. They run our investment platform and among other things. And of course, they also help us put out all those statements and paperwork that you all receive. That is differentiated from what I would characterize as the roots of the tree, which are the custodians. And our custodian is known as NFS, or National Financial Services, which is a division of Fidelity, which is one of the largest asset managers in the world. And the custodian is distinct from the broker dealer. They hold and safeguard all client assets. They also maintain all the books and records and the transactional history of all those assets, including taxes and whatnot. So that's separate and distinct. So think of them as almost like the vault where everything is held and recorded. And then you can think of the advisory firms like ours as the branches of that tree. And there's a lot of advisory firms that all connect in to a common broker dealer and a common custodian. And if you really want to take the analogy that much further, well, us advisors, we're like the leaves on the branches, right? So that's really just a quick explanation of how kind of the system works and what we rely on these vendors for. And hopefully that helps clarify some of the questions we've been getting as we made this transition from Avantax to Cetera. So getting into the headlines, what have we been hearing about? Well, everyone talks about the Federal Reserve. Are they going to continue to cut rates? And right now, there is some questions over whether the Federal Reserve is going to continue to cut rates, right? And there's been some internal dissension among Fed members about that. So that is interesting. We'll touch on that a little more. And of course, every other headline seems to be about artificial intelligence. And by the way, all these headlines came through in the last week or so. This one is from Barron's about a lot of these mega deals that are being done within each the AI universe, which is creating some anxiety. Because these are the deals of these sizes we really haven't ever seen before. Another headline is that this AI boom is looking more and more fragile. That only came out last week in the journal. There are reasons to believe that a lot of the debt that is financing all this AI infrastructure build out might be coming under a little bit of pressure. We're seeing headlines about that. And we're also seeing headlines about how inflation is still a problem, right? We've seen headlines about how the administration is thinking about trying to bring prices down. But and why is that happening? Well, it's happening because let's look at the inflation numbers. If you look at this chart actually shows the CPI, which is the Consumer Price Index, going back about 14 or 15 years. And if you look at it on a month-over-month growth rate, it shows that 55% of the items in the CPI basket, in other words, what is the CPI? It's just a basket of all these goods that the government tracks to try and determine, are prices going up or are they going down and at what rate? And it says that basically more than half of the items that make up the CPI are growing faster, meaning inflating more than 3% a year. That is why the administration is taking these measures to try and bring prices down. And that is why the Fed is starting to debate as to whether cutting rates further this year is a good idea. Because when the Fed cuts rates, that's arguably stimulative to the economy. And stimulative usually means price pressures in the form of higher prices. So that's kind of the big debate that's happening right now. And then one other headline, let's not forget, we talk a lot about stocks in the equity market, but bonds have actually had a really good year this year. And basically, they've had the best year they've had since 2020. So bonds have been doing their job. And part of the reason behind that is as some people get a little nervous, perhaps, about stock valuations, well, what are you going to do with your money? You can do two things, really. You can put it into cash or you can put it into bonds. And that's been driving bond prices higher because of demand for those more conservative, predictable income streams. Now, there's also been a lot of activity in the non-public markets. And there's a lot of headlines that are coming out about some interesting little blow-ups that have happened in the private markets. If anyone has read headlines about a firm called First Brands, there's also another firm called Tricolor that basically went out of business or went bankrupt in a very, very short period of time. There's actually a ton of headlines about this. And, the bottom line is, what does that mean? Well, what it really means is that the level of due diligence on Wall Street perhaps is deteriorating a bit. Because when things are really hot and everything is go-go, as it is right now, companies or banks trip over themselves to land and finance a lot of these deals. And when that frenzy is going on, sometimes they can miss a few things. And so I'll never forget when in my days at Standard & Poor's, one of my colleagues, he was talking about how, and we were talking at this point about the securitization market and mortgage-backed securities. And he said, in this business, it's kind of like a lot of the players act like gold miners. And so if a gold miner finds a vein of gold, they mine that as fast as possible until that vein is exhausted. And to some extent, that is mirroring what is playing out today in terms of firms chasing a lot of these deals and perhaps not being as diligent as they should. So shifting now to talk about artificial intelligence because that's what everyone's talking about. So I think it's really important to talk about it in an investment context. The absolute level of spending that companies are doing to build out their artificial intelligence capabilities is really astonishing. I mean, this headline, throws out a $5 trillion number. And I think the interesting thing, and if you read between the lines, a lot of what analysts are saying is that even if everything turns out really well with artificial intelligence, inevitably there's definitely going to be big winners, but there's also probably going to be some big losers, given the amount of capital that's involved and the nature of the kind of dynamics and competitiveness in the artificial intelligence ecosystem. And so if you dig into kind of the spending that is going on, it's really unprecedented. I mean, it's almost hard to capture in a chart, but this is really just showing um, planning in terms of gigawatts of capacity, in terms of power capacity for data centers that are being built in this country. And what are data centers? Data centers are the places where a lot of this computing power is being stored and built out. And data centers are the where all these computer servers are lined up in racks and racks and racks, and they need a lot of energy to run. And so, all this AI spending is translating into real estate investment, construction investment, energy infrastructure investment. And all that spending is going to have to be recouped somehow, right? And the expectation is that increased spending by consumers and businesses on AI powered products will recoup all that spend. Now, that's a debate. Maybe that plays out, maybe it doesn't. Um, but in such a future, definitely AI cloud service providers are going to see rapid revenue growth, and we have seen excellent revenue growth from them already, as well as strong earnings. Uh, and so that's really what we're trying to dig into is how real is this, and will it play out the way all the optimists thinks it will? And so, you know, if you look at, and the chart on the left actually shows the quarterly capital expenditures by just four big companies, which is Amazon, Microsoft, Alphabet, and Meta or Facebook. And, that last bar on the right is basically showing that those four companies combined are spending over $100 billion a quarter in CapEx. And just to put that into context, the entire CapEx for all the capital expenditures of every company in the S&P 500 combined is give or take about $1.2 trillion. So these four companies represent over a third of that annual CapEx spend. Um, and for other context, I mean, the entire rest of the world, in other words, non-US companies like Europe, Australia, Far East, all their CapEx spending combined is only about 250, 300 billion. Again, these four companies are doing more than that. Uh, and on the chart on the right, that's showing the amount of capital expenditure as a percentage of their sales or revenues. And you'll see that for, Amazon and Google, it's about 20%, and for Meta and Microsoft, it's even higher, well above 30. And to put that into context, normally CapEx is about, depending on the industry, between 2 and 6% of sales. Certainly not over 20%, and definitely almost never over 30%. So that just gives an idea and perspective on how incredible this AI build out is and how much money is being spent on it. And we touched on this a little bit last time in terms of circular AI deal making. And this chart is courtesy of the Wall Street Journal in terms of showing how one company invests in another company that promises the same company to reinvest back in. And so it gets a little complicated. And so as a reminder, what's a circular deal? It's basically when investments are flowing between companies that kind of buy or sell from each other. They have been becoming more common in the AI industry because of all the power that is needed and computing power that's needed to build out what these companies are trying to achieve. Um, and part of this chart says, as an example, NVIDIA, which is the largest company in the world. And by the way, I should mention that NVIDIA's earnings came out, yet quarterly earnings were published yesterday. That was a big moment for the market because everyone was waiting to see what the largest company in the world would say about whether or not their earnings are getting better or starting to slow down. And for all intents and purposes, their earnings actually were above expectations. And the market loved that because what that told the market is maybe this AI spend isn't hype after all, right? And so Nvidia's earnings were a source of comfort yesterday. Um, but at the end of the day, there is an analogy to this circular geomaking. I don't know if people recall, but back when the dot-com bubble burst back in 2000, right? What was the industry that was really getting ahead of itself was telecommunications. And the poster child for vendor financing that was going a little out of control was the company known as Lucent Technologies. Lucent was lending billions of dollars to upstart telecom providers to build out Lucent's infrastructure and network. And so in the boom years, all that money that Lucent was giving to all those companies really helped Lucent accelerate their sales growth. But then some of those companies started to go bust. And when they ran out of cash and couldn't raise fresh capital, Lucent ended up having to write off all those bad debts and book huge losses, and their earnings came crashing down. And of course, the rest is history in terms of the dot-com bubble. So I'm not saying that's exactly what's playing out today, but there are some analogous situations. And so, not to beat a dead horse here, but you can draw some lessons from history. And on the chart on the left, it's basically telling us that investment spending, in other words, capital expenditures, does often get ahead of itself during boom times. And you can see the level of spending that was happening right up until the dot-com bubble burst in 2000. And then, of course, that spending came crashing down. And you can see now the level of spending as a percent of GDP is actually almost at the same level as it was before the dot-com bubble burst. On the right side, it just notes how corporate debt rose dramatically and free cash flow started to deteriorate before the dot-com bubble burst. And the gray bar indicates when we had a recession. And you can see a little bit of a similar trend now. So all that being said, I do think that, in the short term, you can have some speculative excess. But I do believe that long term, we are in a powerful technological wave of change, thanks to artificial intelligence, that will ultimately end up being incredibly important to productivity and earnings and growth. So I do think you can always have hiccups in the short term, but I do think that in the long term, we are really seeing something pretty special happening. Okay, so speaking of this year, we only have a little more than a month left. It's really been a great year. And this kind of shows index returns on a year-to-date basis. And leading the way, by the way, is not the US. The US, as represented by, let's say, the S&P, up about 14% through yesterday, whereas emerging markets are more than double that, close to 30%. Developed European markets and Asian markets are up a little over 23%. So again, international has been a very important diversifier this year, right? And so that's one of the reasons we talk about making sure that portfolios are diversified, because as I've mentioned, we do see a lot of people who do have lower than what you would think they should have in terms of international exposure. Now, a year ago at this time, early November, the price to earnings ratio, or the forward price to earnings ratio of the S&P 500, was around 22. And historically speaking, that's expensive. And we said that was pretty expensive at that time. And we thought that caution was in order. And here we are today. And where is that forward PE ratio? Well, actually, it's actually just slightly below 22 at the moment, or about 21.1. So you might say, well, wait a minute. If the market's gone up dramatically over the last year, how is it that that PE ratio has come down? And that has to do with earnings. Remember, it's a ratio, right? So you have the price over earnings. So what has happened is that earnings have surprised to the upside. And actually, the third quarter earnings season is now fully behind us. And I think the stat is about almost 80% of the companies that reported earnings that surpassed what was expected from all the analysts who follow those companies. And that is a good thing. And so it basically means that the market, which always looks ahead, was anticipating strength in companies' earnings. And that's really what has played out, which ironically then therefore actually slightly lowered that forward PE ratio, but it's still at a high level historically. And just for perspective, if people, think about what happened this year, I mean, at the end of October of this year, the S&P closed at an all-time high, right? And a little more than 3 years before that, in mid-October, the index bottomed out in 2022. And since it bottomed out in October of 2022, the S&P has returned over 100%. And at the end of the day, investors are taking on more risk today in the equity markets than almost any other time over the last 3 years. And valuations at these levels are rare. And, when you kind of like when you hike at very high altitudes, valuations don't stay at those levels very long and that air gets thin. So I do think caution is warranted. We'll talk a little bit more about that. But when you think about valuation, sometimes it's helpful to look at what I would call longer term valuation measures to kind of filter out maybe some short term noise. And so this chart, which I think is interesting, and thanks to our friends at Apollo for putting this together, looks at both the Shiller CAPE and the Buffett indicator. What are those? Well, first, let's talk about what is the CAPE? Well, the CAPE is the cyclically adjusted price to earnings ratio. So Robert Shiller, a Nobel Prize winning economist, decided that he wanted to look at a price measure that was smoothed out business and cycle volatility. And so the CAPE is taking the price of the market and dividing it by its 10-year average real earnings or inflation adjusted earnings. And that gives you a better idea in terms of, is this really out of whack based upon a much smoother, longer term trend? And so as you can see, the last time the CAPE was up in this territory, which right now stands around 40, was, you guessed it, right before the dot-com bubble burst. So the CAPE is certainly telling us that things are expensive. And then what about the Buffett indicator? And so, Warren Buffett, one of my heroes, the former CEO of Berkshire Hathaway, incredibly wise investor, he came up with what was known as the Buffett indicator. And basically, Warren Buffett said, look, at the end of the day, the sum total of the market capitalization of all publicly traded companies shouldn't be that much more than our company's gross national product, right? And so if you look at the way it's calculated, he basically says that you look at the total US stock market capitalization, which in this case is $67.8 trillion, and then you divide it by our gross national product, which is about $30 trillion. And that comes up with the Buffett indicator, which is really a ratio, which right now stands over 220%. For context, historically speaking, anything under 130%, people would say, oh, well, the market might be a little undervalued. But anything over 185% is dramatically or not is overvalued, right? And so the implication here is that the future long-term returns of equities probably are going to be lower because valuations are so elevated. And that's really what this chart is telling us, because here we are in 2025, and never have we seen what I would call that extreme level of these two longer term indicators flashing a warning sign. Now, that doesn't mean a crash is imminent, but it does mean that I think we need to temper our return expectations moving forward. Also, One other interesting way to look at things is to look at what are some big smart guys at Goldman Sachs talking about in terms of valuation. So this chart actually gives a range for not just the U.S. but all the other markets out there in terms of between 80% of the time is represented by the thin line, and the diamond is where we are now, and the median is the little square. So it doesn't really matter where you're looking, with maybe the exception of Japan. We're pretty expensive in terms of valuation. I mean, Goldman uses the term global valuations are currently at an elevated level. I think that's a nice way of putting it. So what does that mean in terms of long-term valuations? Well, Goldman puts out a lot of research about what are realistic expectations moving forward for returns in the equity markets. And so basically, to steal the headline here, they basically think about a 7% annualized return over the next decade is a reasonable assumption. But they also break it down. And, if you look at it, they're actually assuming that there's going to be better returns outside of the US. They're pegging the US on average at 6.5%, whereas the rest of the world they're pegging at a lot, well, not a lot higher, but reasonably higher, particularly in the emerging markets. And we've certainly seen that play out already this year. Now, again, Goldman Sachs, big investment bank, of course, we have to take what they say with a grain of salt because they're not going to tell everyone to put on the brakes. But nevertheless, they do put a lot of work into this. And interestingly enough, if you actually look at the bar here, they break it down by what the contribution to those returns will be. And you'll notice that the light blue part is valuation. And what they're saying is the valuation component of the return is actually negative, meaning things are overvalued. So the returns that we're going to get from equities moving forward is going to be a combination of earnings growth, which is obviously the biggest part, but also dividends, and everyone knows I love dividends, and buybacks. What are stock buybacks? Well, when a company issues stock over time, they can choose to buy back some of that stock, which reduces their public float, which ultimately is good for shareholders because it's reducing the number of available shares to purchase, which ideally should make the stock a little more valuable because you're reducing the supply. And if the demand is still the same, that ideally should move the stock price up over time. So, I don't mean to sound too bearish. What are some comforting factors that should make bears sleep better? Well, as I always say, it's always about earnings. When you buy stocks, what are you buying? You're buying the future earnings potential of those companies. And that's why the market was so focused on NVIDIA yesterday. NVIDIA being the poster child for artificial intelligence investing, the largest company in the world by market cap, their earnings were great. So earnings are delivering on these lofty expectations. Now, the other thing that should make bears sleep better is that there is lots of cash on the sidelines. So the Investment Company Institute, which tracks fund flows, is basically telling us in this chart that money market fund assets, and money market funds are kind of like cash equivalent, very short term, very safe, are now well over $7 trillion. That's a lot of money sitting on the sidelines, earning probably not the best return, waiting to be invested. And so, to some extent, if we do have a pullback or a correction, I do think a lot of investors who have missed out so far on these awesome returns will be ready to jump back in. And sure enough, this is a headline recently from the Wall Street Journal, which talks about how buy the dip investors saved stocks from having a bad week, right? Because when things looked like they got a little dicey, there was a lot of cash flooding in to buy at some lower levels. So we are seeing that play out a bit this year. So with all that being said, it's always it's like a push and a pull between the bulls and the bears, right? And so what are we paying attention to this quarter and beyond? The bulls are saying, hey, when you're in a bull market, most bull markets have a theme. And undoubtedly, this theme is all about artificial intelligence. And, I thought this quote that I read in a research report was pretty bullish in the sense that, this analyst was saying that AI represents the technological opportunity of our lifetimes. And we're going to be talking about the artificial intelligence revolution for generations. Our grandchildren will recount the early days of AI as a pivotal moment in history. And to piggyback on that comment, I always joke around with my kids that I feel like someday, and maybe not my kids, but my kids' kids will say, "Can you believe that there were days when people actually drove themselves? How dangerous was that?" That's perhaps where technology is going. Um, Now, uh, there's also the argument that, at the end of the day, yes, there's a lot of capital expenditures, but these big tech firms are making incredible amounts of money. And so they can afford to do this spending. Now, on the other hand, the bears are saying that, wait a minute, what if the Fed doesn't cut? What if inflation is still a problem? Aren't we kind of in a mini bubble with all this AI exuberance? It's going to pop. And by the way, the market's performance has been so good that can't last. Normally, every 3+ months or so, we have at least a 5% correction in the markets. We haven't had that, so that's got to happen soon. So, the only other comfort I can say is that usually market pullbacks don't happen when you have a lot of bears talking, right? Market pullbacks happen when everyone's thinking everything is great. So it does give me some comfort that there is a lot of laser focus on, is all this AI spend worth it? Are we in a bubble? Because as long as there's a lot of that chatter, I do think that perhaps we haven't really seen the top just yet. So ultimately, what does that mean we're doing? And I know at this point, perhaps I sound like a broken record, but we still think caution is in order. We still think it makes sense to lean a little bit more conservatively. And obviously, global diversification matters. So we are making sure that we do rebalance, make sure that we're pulling out of U.S. markets that are probably gotten ahead of themselves and reallocating elsewhere. And we do think that, despite the fact, like I said, bond markets have had a great year. So bonds have done their job. So even if you were just in all bonds, you still had a year where you're making almost double-digit returns, which is really quite nice for fixed income investments. So with that, I will take a pause and we can move into Q&A.
Great. Thank you, Steve. As a reminder, if anyone has any additional questions, please submit those now. We still have time to answer a few. Starting out, Steve, you mentioned when we got started that you were going to talk about some of the biggest mistakes you've seen made by clients. So can we hear a little bit about that?
Yes, absolutely. So I'm gonna talk about two, and so I think the first one that we see a lot of is, believe it or not, and I'll call this a good mistake, is a lot of clients have too much savings. And what I mean by that is a lot of our clients have done a great job accumulating wealth. They've worked hard, they've spent wisely, they've invested wisely, and what happens ultimately is sometimes they fail to realize that, time is precious and there's only a certain window you have to have certain experiences, right? And so, as a personal example, I'm a big mountain biker. I love to mountain bike, and I've been talking about doing a Northwest Arkansas mountain bike trip for years with my mountain biking buddies because I've read great things about what's going on in Northwest Arkansas. And so finally, one of my friends said, you know, you've been talking about this for a long time. When are you going to do it? And he's right, because I'm not getting any younger. And as time goes by, even though I can afford to do it now, it's all about carving out the time, making the commitment to maybe spend a little and have some fun while you still can. Because if, you wait until it's too late, you don't want to have that type of regret. So I do think sometimes clients need to take a step back, really reassess about, hey, what are some of the things on my bucket list that I really want to be able to do or that I haven't done? And I have to find and make the time to do it because certainly most of them have the assets and the wherewithal to do that. So that's one thing. And one other mistake that we do see, and many of you who have, from an older generation have seen how expensive uh, long-term care is, right? And assisted living, all that. And so one thing that we do see is in general, many clients sometimes or tend to overinsure on life insurance, but they underinsure on long-term care, right? And I think as in health, the old saying goes, an ounce of prevention is worth a pound of cure. I think the same thing goes true for long-term care. If you start early with a long-term care policy, it's a lot more, how shall I say, economical to actually have long-term care coverage as opposed to waiting until you're more advanced in age and then all of a sudden realize that maybe it is a good idea to have it, but then it becomes a lot more expensive, right? And so we are having a lot of conversations with clients about that because that is one big deficiency we see across the board, and it's not just with us. It's just that's from what we read. It's kind of systemic in the industry, and it's a difficult subject to talk about, of course, but that doesn't mean you shouldn't talk about it. So those are a couple of things that we see often, Katie.
Great. I think that's great advice. Thank you, Steve. We did get a couple of questions. One of them was someone asked, I'm not sure you'll be able to answer this entirely, but someone asked, why did everything suddenly turn red in the market today?
Well, that's always a good question. And sometimes it's really hard to understand short-term market movements. And again, maybe if I had to guess, I mean, yesterday Nvidia surprised everyone with great earnings. So this morning things started off wonderfully because people were like, "Great, Nvidia's doing well. Isn't the world great?" I think maybe people started to dig into the numbers even more and started to look at things and maybe started to reassess and maybe say, oh, things are good, not great. So maybe this overexuberance isn't totally isn't justified. And lo and behold, Nvidia, which was up in the morning, is now down about 2% or so. I think if my charts are correct. So, that's just sentiment, right? And that's just analysts having more time to dig into the numbers, update their spreadsheets for future earnings growth, and adjust accordingly. So, but again, in the long term, do I have confidence that things will be just fine? Absolutely. But like I said, in the short term, there can be some trouble.
That makes sense. Okay, and our last question, unless anyone else has any, was how do you view the role of private credit in the markets today, especially given the shifting interest rates and economic uncertainty?
Oh, that's a great question. A huge topic. I'll try and be brief on that. But, in the wake of the great financial crisis, a lot of banks stepped back from lending. And so the who stepped into that void were private credit firms, and particularly private equity firms like Apollo, Blackstone, KKR, Carlyle, right, who have huge amounts of money and they started lending. So they started expanding the private credit market, right? And so that has actually, there's been a ton of private credit financings as a result of more traditional banks stepping back from a lot of that lending. And it's only grown from there. And so now the concern is, and I was showing some headlines about some of those private credit events, the concern is maybe that market's gotten a little overheated. Um, and it's also harder to really track because it's not public. So the data is less prevalent to really dig into. So that is a concern that maybe private credit has gotten ahead of itself a bit and are making, some investments in loans that are perhaps a little too aggressive with maybe not enough protections, right? Because anytime you're lending money, in the form of a loan or a bond, it's governed by, rules and or known as covenants. And, now the terminology out there for a lot of these deals are called covenant light, meaning a little light on the rules, and that sometimes can be problematic. So, but at the same time, private credit has allowed for a lot of financing and growth in a lot of these companies that really couldn't find their financing elsewhere, and that's been really great for a lot of startup companies who are doing interesting things. So, it's a double-edged sword. So hopefully that addresses that question a bit.
Great, I think so. Okay, that at least wraps up our questions. I want to thank you, Steve, and thank you, everyone. Just a quick reminder before we close out, we did record today's session, so we will send that out to attendees. And also, there will be a survey for feedback that will appear in your browser when we end today's webinar. So your feedback helps us shape future topics and make sure we're addressing what matters. So we appreciate hearing from you. And with that, Steve, any closing remarks before we end here?
No, thank you as always, Katie, and thank you all for joining, and look forward to seeing you next year.
Yes, like Steve said, happy holidays, and we will see you next year. Have a good rest of your week. Thanks.